So you go from crypto winter to crypto spring, then into crypto summer. And in crypto summer, you start to get more movement slowly back towards fair value. And once you get to fair value and you enter crypto fall, where we are today, the speculators start to come out. And the speculators start to come out because the price starts to move more. Then the halving occurs. Well, the halving makes the price start dropping. As I said, the miners aren't going to sell unless someone offers them a bigger price because they can't cover their costs. So they hold longer until people bid more. And so the price starts to move, then the guys start to come in. And most crypto traders, there's this group in DC called the Cult of Kelton. Stephanie Kelton convinced the politicians that they could issue as much debt and as much money as they wanted with no consequences because we have the world reserve currency. That's one of the dumbest ideas in the history of economics. And economics is replete with dumb ideas.
Hello everyone, and welcome back to our channel. Mark Yusko begins by emphasizing the critical role of liquidity in driving markets. He argues that Bitcoin is often misunderstood as a risky asset comparable to tech stocks or venture capital. However, Yusko believes that Bitcoin's price is primarily driven by the creation of money, the unit in which Bitcoin is denominated. If the money supply remained constant, the price of Bitcoin would only fluctuate based on the demand for Bitcoin relative to its supply. A key aspect of Yusko's analysis is Bitcoin's 4-year halving cycle, which is hard-coded into its protocol. Every 4 years, the supply of new Bitcoins is halved, reducing the rate at which new Bitcoins are created. Yusko suggests that this mechanism is designed to attract attention and create price movement in a nascent asset. The halving cycle ensures that Bitcoin's price fluctuates, which in turn attracts investors and traders at different stages of the cycle. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Liquidity drives markets. Forever and always, liquidity drives markets. But the point that's missing there is it's not that Bitcoin is a risk asset like, tech stocks or venture capital, and that's being driven by liquidity. I think it's the exact opposite. It's the creation of money, which is the unit in which we denominate Bitcoin, is what drives the price. So if the money supply stayed the same, the dollars per Bitcoin would stay the same. And the only thing that would move the price of Bitcoin would be the demand for Bitcoins, the actual tokens, relative to their supply. But that would be, ceteris paribus, all things equal. But all things are not equal. Sometimes the money supply is expanding, sometimes it's shrinking. And yes, Raul's right, there is this liquidity cycle and debt repayments and all that good stuff. But here's the thing. The money supply over the last 12 months has contracted actually for the first time in 100 years in the United States. And yet the price of Bitcoin almost doubled. Well, how can that be? Well, it's because the uncoupling of those cycles, in the sense that if you go back to 2020, when the world lost their minds and passed the dumbest set of rules in the history, literally, of mankind. And that's hyperbole, but I believe every word of it. We took the seasonal flu, we weaponized it, and we ran a control experiment on the world to see how much shit people would actually take, right? And because of that, they convinced, there's this group in DC called the Cult of Kelton. Stephanie Kelton convinced the politicians that they could issue as much debt and as much money as they wanted with no consequences because we have the world reserve currency. That's one of the dumbest ideas in the history of economics. And economics is replete with dumb ideas. I mean, there were lots of dumb ideas. That's the dumbest of all of them. And so we've been a republic for 247 years and 248 years. And for the first 244, we issued $10 trillion. Then we issued $10 trillion in 2 years. That was a bad plan. And so if you think about it, if we doubled the money supply, what should have happened to the price of gold and Bitcoin? They should have doubled. Curiously, if you go back right before the pandemic, Bitcoin is around 15,000. And before the shenanigans with Sam, it was at 30,000. That's really interesting. And that's just Bitcoin denominated in dollars. And the same thing happened at my house here in Chapel Hill. According to Zillow, my house went up by 50%. No, it didn't. My house did not grow. My house did not get more efficient. I actually had to put money into it because we were wearing out, but that's not the point. What happened is the money got worse. The money went down. The money was devalued. And so what happened was Bitcoin got pushed below its fair value, its fair exchange value of 30,000 down all the way to 15,000. Why? Because people were afraid of the liquidation of FTX and all the scandal and was Tether a fraud and all this FUD. And so you had a temporary dislocation. And so yes, money supply was contracting, and yet Bitcoin prices went all the way back to 30,000 and then higher to 40,000. Not because they are inextricably linked to the money supply at the moment, and not because it's inextricably linked to the what's happening in the government. I believe it's because of the 4-year cycle. And the 4-year cycle is tech, like code, right? It's hard-coded into Bitcoin that every 4 years you decrease the supply by half. That's a really interesting idea. Why would you do that? Well, it's interesting. My theory, and this is my theory, is you do that because it's guaranteeing movement. And if you have a nascent asset, what you need is something to attract attention. And movement in price would attract attention. So if you think about the 4-year cycle, when the price is below fair value, in the middle of crypto winter, right, where everyone is sold, price goes below fair value, investors, right, people like me and others, who our job is to buy things below fair value. That's what an investor does. So they start to buy, and the price stops going down and starts to go up. So then, as the price starts to get close to fair value, the traders come in. The traders don't really care about fair value. They just want to scalp. They need movement. They need things to be stable and moving. They may go long, they may go short. They don't really care. As the price starts to get back above fair value, so you go from crypto winter to crypto spring, then into crypto summer, and in crypto summer, you start to get more movement slowly back towards fair value. And once you get to fair value and you enter crypto fall, where we are today, the speculators start to come out. And the speculators start to come out because the price starts to move more. Then the halving occurs. Well, the halving makes the price start dropping. As I said, the miners aren't going to sell unless someone offers them a bigger price because they can't cover their costs. So they hold longer until people bid more. And so the price starts to move, then the guys start to come in. And most crypto traders, this isn't a value judgment, it's just a fact, are guys. And they happen to mostly be younger guys. And they tend to be a little more overconfident and a little more over trading. And those speculators come in. But then the problem is the gamblers come in. And these are all walks of life, males, females, older, younger. And these are the people that look at the price moving and they're like, oh, this is easy money. And they borrow money to play it. And that's what gives us the parabolic blow off. And then eventually somebody says, nope, that's too high. And they short it. And we start the cycle all over again. And, we had the futures facilitate that twice, and it'll probably be, something else next year.
In the latter stages of Bitcoin's market cycles, speculators and gamblers play a significant role. Speculators, often overconfident and prone to overtrading, enter the market as prices rise. Their activities contribute to the parabolic price increases seen in bull markets. However, this also sets the stage for eventual corrections when prices become unsustainable. Yusko notes that the presence of these market participants is not unique to Bitcoin, but is a common feature in all asset markets. The cycle of speculation and correction is a natural part of market dynamics, driven by human psychology and behavior.
On December 17th, 2018, so, the price had gone to 10,000 for the first time, and it wicked over 6-7 weeks to 20,000 on December 17th. December 18th was the day of the first futures contract. And it was small. I mean, it wasn't even a very big one. And I actually tweeted out that morning saying, this is going to be bad. And now I didn't know it was going to go down all the way eventually by the middle of 18 to 3,000. I said it was going to fall probably back to 10, where because at the time fair value was closer to, 6 to 8,000. So long story short, it was literally the day of the peak. And we went down up, for a year until, early 19. And then we started back up. By December 16th, 18 was the very bottom at 3,200. Then in 21, to your point, November 6th, 21 was the day of the peak again, but this was the big futures contract. This one let everybody and their sister go short Bitcoin and push that price. And the problem is we were already 100% above fair value. Now, what I keep talking about fair value. What is fair value? Well, fair value comes from a Metcalfe's law model. We can model any network based on Metcalfe's law. We can determine the fair value based on the number of participants and the number of connections and the nodes in the network. And Tim Peterson has done a lot of great work on this. And long story short, if the fair value was $10,000, then, and we go to 20,000, we're eventually going to fall all the way back to 10 and usually fall through, and you get really undervalued. Then the investors come back and they buy the asset. And so if you remember back when GBTC was launched, so GBTC was launched and we were about $10,000, and suddenly we had this wick all the way up over, the holidays of 2020. 2020, holidays 2020, up through 60,000. In January of 21, we hit 60,000. And then Elon did his famous tweet, we're not going to take it anymore. And it went down 50%. And we went from 60 to 30. And it wasn't overnight, but, over 3 months. And people by summer were like, oh my God, it's over. It's going to zero. Yeah. And then people started buying GBTC and Michael Saylor started buying. And boom, we went all the way to the 69 on that November 6th date. The problem was fair value at that time was only around 30. So here we are at 70 or 69 or 67, I guess. And fair value is 30. So we definitely had to fall. But now you've got the short sellers in the futures market pushing the price down, and we went all the way down. Then we stabilized in June, and then Terra, I would say it's kind of ironic that Luna went to Terra, right? I mean, the moon fell to the earth. And so that was the start, and then Three Arrows, and then, BlockFi and Celsius and Voyager. But then the big killer beast was, Sam Bankman-Fried, and everything got wiped out, and we made that low at kind of the high 15,000s. And again, people were like, oh my God, we're going to zero. And like, the more people say we're going to zero, that's got to be the bottom. And of course it was the bottom. And then we just marched incessantly up, to the launch of kind of where we are today. So
Yusko reiterates the importance of fair value in assessing Bitcoin's long-term outlook. Using Metcalfe's law, fair value can be estimated based on the growth of the Bitcoin network. Despite short-term volatility and speculative excesses, Bitcoin's fair value tends to rise over time as adoption increases and the network expands. He highlights that during periods of extreme undervaluation, value investors step in to buy Bitcoin, setting the stage for the next phase of price appreciation. Conversely, during periods of extreme overvaluation, speculative excesses are corrected, bringing prices back in line with fair value. Please like and subscribe my channel.